The crypto market is bleeding. Bitcoin just shattered a critical psychological barrier that traders have been desperately defending for weeks, plunging below $90,000 in a violent sell-off that's wiping out billions in market value and leaving investors scrambling for answers. But this isn't just another routine crypto correction. This is a perfect storm of geopolitical chaos, institutional panic, and macroeconomic uncertainty that's threatening to drag Bitcoin down to levels we haven't seen in months. And here's the terrifying part. Some of Wall Street's top analysts are now warning that $75,000 could be next, with one prominent strategist even suggesting Bitcoin could eventually crash all the way to $10,000. So what the hell is happening? Why is the entire crypto market in free fall? And most importantly, is this your chance to buy the dip or a warning to get out before things get much worse? Let's break down everything you need to know. As of Tuesday morning in Asia, Bitcoin crashed to 88.94, marking its lowest level in more than a week, and representing a brutal 3-4% drop in just 24 hours. But the real damage is even worse when you zoom out. Since hitting nearly $98,000 on January 14th, a level that had traders celebrating the return of crypto's bull run, Bitcoin has now shed more than $8,000 in value, erasing gains that took weeks to build and leaving bulls wondering if the party is officially over. And it's not just Bitcoin taking the hit. The carnage across the broader crypto market is absolutely devastating. Ethereum, the second largest cryptocurrency, has collapsed more than 7% and crashed back below the critical $3,000 level for the first time since January 2nd. Solana, once the darling of the 2024 rally, has plummeted 8.24% and is now trading around 20.40, down a staggering 4% in just 6 days. XRP, Cardano, and virtually every other altcoin are drowning in red, with smaller, less liquid tokens getting absolutely demolished as panicked investors flee to safety. The total crypto market capitalization has been gutted by roughly $100 billion in just days, according to CoinGecko data. That's $100 billion in wealth that simply evaporated into thin air. Trading volume has exploded to $68.6 billion as traders rush to exit positions, while CoinGlass data shows a bloodbath in the futures market with approximately 23.5 times 7 million in Bitcoin liquidations alone. That means leveraged traders who bet on Bitcoin going up just got completely wiped out, their positions forcibly closed as the price fell below their liquidation levels. Harm Dandashi, an over-the-counter trader at crypto trading firm Flowdesk, called $90,000 a critical level that we've seen hold as support since the early days of the year and is likely an important inflection point in the short term. Well, that support just broke. And when critical support levels shatter in financial markets, it often triggers cascading sell-offs as stop losses get triggered and fear spreads like wildfire. So what's causing this absolute carnage? The immediate trigger is geopolitical chaos emanating from the White House. And it centers around one of the most bizarre political controversies in modern history, President Donald Trump's obsession with taking control of Greenland. Over the weekend, Trump didn't just suggest that the United States should acquire Greenland, he threatened to economically punish any country that stands in his way. Specifically, he announced plans to impose a 10% tariff on goods from 8 European countries starting February 1st, with that rate escalating to a devastating 25% by June 1st unless there's a deal for the purchase of Greenland. Let that sink in. The President of the United States is threatening America's closest allies, members of NATO, countries we've stood alongside for over 75 years with economic warfare over an island that belongs to Denmark and whose people have zero interest in becoming American. The response from European leaders was swift and furious. European Council President Antonio Costa and Commission President Ursula von der Leyen issued a joint statement warning that tariffs would undermine transatlantic relations and risk a dangerous downward spiral. Denmark's government called the threats unacceptable. Brussels has now threatened to retaliate against Washington if Trump follows through, potentially triggering a full-blown trade war between the United States and Europe. The International Monetary Fund jumped into the fray, warning that Trump's tariff threats could trigger a spiral of escalation that spills into broader financial market stress. And that's exactly what's happening. Global markets are in chaos. Japanese bonds plunged, with yields on 30 and 40-year securities jumping more than 25 basis points, a massive move in the bond world. The Nikkei fell 2.5% overnight. Germany's DAX declined 1%. Major US stock indices dropped more than 1%, with the Nasdaq falling nearly 2%. But here's where it gets really interesting. While stocks and crypto are getting hammered, safe haven assets are absolutely soaring. Gold surged 3% to hit a new record high above $4,725 per ounce. Silver jumped 7%, also reaching all-time highs. The Japanese yen and Swiss franc currencies investors traditionally flee to during times of uncertainty strengthened against the dollar. This is textbook risk-off behavior, where investors dump anything perceived as risky and pile into assets that historically hold value during chaos. And make no mistake, Bitcoin, despite all the talk of it being digital gold and a safe haven asset, is getting treated as a high-risk asset right alongside tech stocks. Jiliang Tang, managing partner of Monarch Asset Management, explained it perfectly. Bitcoin's sharp drop over the weekend mirrors a broader exodus from risk assets in traditional macro markets due to the White House's threat of tariffs on European nations as well as geopolitical frictions over Greenland. Gold and silver's rally as well as the dollar's weakness all underscore this narrative of capital fleeing to safety triggered by aggressive posturing. Wall Street is even talking about a sell America trade, where investors are actively dumping us stocks, bonds, and dollars as Trump threatens allies with economic punishment. Reuters called Bitcoin a liquid proxy for risk, and that designation is playing out in real time as institutional money flees crypto alongside other risk assets. But wait, it gets worse. Because while geopolitical chaos was already battering crypto prices, the market faced an additional devastating blow from an unexpected source. Coinbase, the largest cryptocurrency exchange in America, just torpedoed the most important piece of crypto legislation in years. The Clarity Act was supposed to be crypto's big legislative victory, providing clear regulatory guidelines that would finally give the industry the legal certainty it's been begging for. The bill had bipartisan support, was moving smoothly through Congress, and seemed destined for President Trump's signature, Trump being widely seen as the most crypto-friendly president in American history. Then, in a shocking move late last week, Coinbase CEO Brian Armstrong announced the company was withdrawing its support for the bill. His primary objection? The legislation wouldn't allow crypto owners to earn yield from stablecoins. That single concern led Coinbase to abandon legislation that would benefit the entire industry. The impact was immediate and brutal. Russell Thompson, Chief Investment Officer at Hilbert Group, explained, the postponement of the Clarity Act in the Senate committee, mainly due to concerns from Coinbase, eliminated a large amount of positive sentiment in the market. Traders who had priced in the passage of landmark crypto legislation suddenly had to reprice their positions. The resulting sell-off hit not just crypto prices, but also the share prices of crypto-exposed companies. Strategy Inc., formerly MicroStrategy, the Bitcoin hoarding company led by Michael Saylor, saw its shares plummet almost 8%. Coinbase itself dropped 5.26%. SharpLink Gaming, which holds Ethereum in its treasury, fell 7.8%. Bitcoin miner Mara Holdings slumped 5.27%. The entire crypto equity sector got massacred as the regulatory clarity everyone had been counting on suddenly evaporated. Here's where this story takes a fascinating turn. While most investors were panicking and rushing for the exits, Michael Saylor's strategy made its largest Bitcoin purchase since July, scooping up almost $213 billion worth of BTC over 8 days. That's right, amid all this chaos, Saylor doubled down on his Bitcoin bet with a purchase so massive it represents his company's biggest accumulation in 7 months. Jake Ostrovsky's head of over-the-counter trading at Wintermute noted, today's news of Umster's largest purchase in 7 months suggests there's still significant retail and institutional appetite for Bitcoin exposure through equity wrappers. We're seeing BTC outperform ETH on the session on this news. This creates a fascinating dynamic. On one hand, you have panicked retail investors fleeing crypto as geopolitical chaos intensifies. On the other hand, you have one of Bitcoin's biggest institutional believers aggressively buying while everyone else is selling. Is Saylor a visionary catching Bitcoin at a discount? Or is he catching a falling knife that still has much further to drop? From a technical analysis perspective, Bitcoin's chart is looking increasingly precarious. The cryptocurrency peaked above $120,000 earlier in 2025 before entering a clear downtrend marked by lower highs and lower lows. Selling pressure intensified dramatically in November, when prices briefly slipped into the low $80,000 range. Since then, Bitcoin has been attempting to build a base, with higher lows forming around the $85,000 to $88,000 area, while resistance has repeatedly capped moves near $95,000 to $95,000. This consolidation pattern suggested selling pressure might be easing. But now, with Bitcoin breaking below $90,000, that base is looking increasingly fragile. Traders are watching the $88,000 to $85,000 zone as the next critical support level. If that breaks, analysts warn we could see a rapid move down to test the mid-$80,000 or even lower. Wintermute analysts cautioned, the setup feels like we're coiling rather than breaking down, however we need the psychological level of $90K to provide good support here, or we risk testing mid-$80K again. But derivatives positioning tells an even more ominous story. According to Cian Dawson, research head at Derive XIZ, options traders are now pricing in a potential drop to $75,000 by June. From an auctions perspective, the outlook remains mildly bearish through mid-year, Dawson said. Traders are paying a premium for downside protection. Think about what that means. Professional traders, the people with millions of dollars on the line who spend every waking hour analyzing markets, are actively betting that Bitcoin could fall another 17% from current levels within 6 months. They're not just worried, they're putting their money where their predictions are and paying premiums for insurance against further declines. And one analyst is going even further with his bearish call. Bloomberg intelligence strategist Mike McGlone warned that Bitcoin's inability to hold long-term averages in 22.5 is a concerning sign that could eventually lead to a catastrophic drop as low as 10,000. Now, to be fair, that's an extreme outlier prediction that most analysts would consider wildly pessimistic. But the fact that it's even being discussed by a respected strategist at Bloomberg shows just how much uncertainty exists about Bitcoin's trajectory. There's another crucial factor that often gets overlooked in discussions of Bitcoin's price action: liquidity. And here, there might actually be some room for cautious optimism hidden within all this chaos. Data from Capriol shows that US liquidity growth on a year-over-year basis bottomed in November 2025, right around the same time Bitcoin hit a local low around $80,000. Since then, liquidity conditions have started to improve and are now less negative heading into early 2026. Historically, Bitcoin and other risk assets tend to perform well when liquidity is expanding, when there's more money sloshing around the financial system looking for returns. If this liquidity improvement trend continues, it could provide fundamental support for Bitcoin's price even as short-term geopolitical chaos creates volatility. The question is whether liquidity expansion will be enough to overcome the powerful headwinds of tariff wars, regulatory uncertainty, and risk-off sentiment. One of the most interesting debates happening right now among crypto analysts is whether Bitcoin's violent reaction to macro events represents maturation or fragility. Some see it as positive. Beto Aparicio, senior manager of strategic finance at Off-Chain Labs, argued, Bitcoin's reactivity is another sign of its increasing integration with broader macroeconomic forces, signaling maturation rather than fragility even as short-term volatility continues. The logic here is that Bitcoin, moving in tandem with stocks, bonds, and other major asset classes, means it's finally being taken seriously by institutional investors as a legitimate financial asset rather than a speculative toy. Maturation means Bitcoin is no longer operating in its own isolated ecosystem, but is now part of the broader financial system. But others see the same data and reach the opposite conclusion. Farzam Isani, CEO of Exchange Valro, noted, capital is rotating into established safe havens, while crypto continues to trade as a high beta risk asset. In other words, when things get scary, investors still don't view Bitcoin as a safe haven, they view it as something risky to dump so they can buy gold, bonds, and other traditional safety assets. This matters enormously for Bitcoin's long-term thesis. If Bitcoin is just tech stocks with extra volatility, then it will continue to get hammered during risk-off periods. But if it can eventually prove itself as genuine digital gold that investors flee to during chaos, then it becomes a fundamentally different and far more valuable asset. Right now, the evidence suggests Bitcoin is still firmly in the high beta risk asset category, not the digital gold safe haven category. That may change in future crises, but for now, when the world gets scary, Bitcoin goes down, not up.